welcome. This is India Market Open midweek, and it seems like it might just be another tough morning, guys. I know that implied Nifty is indicating to a positive start. We had that yesterday. We rallied up all the way to 21,700 and fell right away. So I'm not getting carried away by what I'm saying on GIFT Nifty is what I'm saying.
Yeah, wish we had Netflix in India because those numbers would have given some bit of a respite.
No, I wouldn't be surprised that a lot of that is, India is a huge growth market
for
Netflix, despite being a premier option. But yes, guys, looking like we might have a bit of relief after brutal closing yesterday, and that's where we're going to keep the focus. Global cues are not really firing. Wall Street has been kind of mixed. Nothing too much happening there because a lot of key data are still awaited. I think Asia is important. Asia has also been all over the place. A week after the Bank of Japan held its rates yesterday, they're also reacting to key data. But Asia overall mixed. So no clear global cues is what I would say. The Hang Seng, while it's doing very well, the Nikkei down in the red. The focus really needs to be on what's happening in Indian markets today. And let's just recap quickly what kind of a close we had. We closed at the lowest levels in over a month. A lot of the fall came in the second half of trade. FII seemed to be perhaps the culprits, and that's what the fund flow numbers are also telling you. It was the big boys, so to speak, which kept the markets really under pressure. Your HDFCs, RIL, SBI, they are the ones that led the losses. And let's quickly just pull up what your fund flows have been overnight to give us a sense of where the selling pressure was coming from. And it's a fifth consecutive day of selling from FPIs, about 3,000 odd crores. DIs were buying, but definitely not enough to hold that pain down. So clearly we've had a rough start, perhaps a bit of recovery on the cards, guys.
You could argue that could be the case. The only thing is markets don't seem to be in this extreme fear zone from where, because it's just been one day, so to say. Yes, last week was bad, but led predominantly by HDFC Bank. Yesterday was the first day of, you could argue, capitulation, because you saw PSUs, you saw media, and not just Z, but Network 18, a bunch of others. So not in an extreme fear zone as yet, as per quant indicators.
We're only 4% up from our record highs. We're
down.
only 4% down from our record highs, which is actually not significant by a mile. We've all talked about a 5 to 10% correction, which is put down as healthy. And we are in a tough month. And of course, I'll leave it back to you about how we shouldn't be getting too concerned, is what I feel.
No, the thing is, the interesting point made yesterday in a couple of notes, and two ways to look at it, that for the Nifty and the Bank Nifty, the short-term support levels that people look at, the 50-day moving average, 100-day moving averages, are very close by. So two ways to look at it. Do we find support at those levels? Or if we break those, then the next levels of supports are way lower. So that is one problem area. Hopefully that is also a positive. A lot of attribution yesterday to the SEBI FPI norms. Frankly, I spoke to a clutch of people after that on the global side as well, or people who deal on sales with global clients. They said, we didn't even anticipate SEBI to do anything. So yes, that newspaper report created a lot of brouhaha, but not too many people are attributing the selling that happened to those FPI norms because nobody anticipated SEBI to extend them. So in the first place.
Step back on Bank Nifty, Niraj. We've maintained this from a while, saying that banks have not performed as well as the rest of the market. In fact, most people were of the opinion from the time we saw that rally between November to December that banks needed to lead the way up. Bank Nifty is up only 18%. The sell-off, this of course comes in after a 7% cut that we've seen in the last few days of trade. So if you put that in perspective, I'm now beginning to think that the China trade is looking a little more attractive for FIs, and that's where the selling is coming in from the spaces where FIs actually hold focus.
Well, been attractive for a while, Samina. So I don't know if,
Bank Nifty or China?
No, China has looked attractive for a while.
But at some stage you give in, right?
Yeah, so my point being that, in fact, early this month on the editor's cut, we did this thing of the EM-China decoupling as well, because Asia ex-China funds are seeing a lot of flows. So not sure if that is the case, but there are reasons for some of these pain to happen. One, a lot of sectors are stretched, and we're seeing, yesterday was the first sign of almost all stretched sectors seeing that fall, right? PSUs have been a manic rally, railways, etc. And we saw what happened yesterday in case in point.
And good call on the solar stocks, Niraj. But your point being that a lot of what is run up, the froth is coming out of the market, isn't it?
Yesterday was the first sign of that, and good that it happens, because you can't have, like we use that idiom, right? Trees don't grow to the skies. So IT is looking resilient. The last point on the banks, right? Sore spot. Yesterday, if you see HDFC Bank, after 4 days of a fall the whole of last week, yesterday yet another corrective move. Delivery-based selling in HDFC Bank yesterday was 5,500 crores. And so net, you know where the culprit is, which is banks. But under the shadow of banks yesterday, we saw a clutch of broader end of the spectrum stocks going off, and a lot of portfolios would have hurt yesterday, guys.
I think all your mutual fund, a lot of your large cap, passive funds, flexi cap funds that have been overweight banks will be seeing a big cut. And honestly, for whatever it's worth, at 1,500 rupees, HDFC looked attractive for a lot of people on the street. At 1,470, that was the same word. We're now at 1,430. The stock has fallen 15% in the last 5 days. From the day it reported its earnings, 1,665 was the high on recent level that the stock actually declined from. So big fall on that one. SBI as well did hit quite badly. Let's not forget that Bank Nifty contributes about 35% of Nifty. So if you have to have Nifty holding itself together, Bank Nifty must and has to lend its support. So if your banks are under pressure, Bank Nifty contributes 35%. Nifty itself will find it hard and will struggle at higher levels where the selling is coming in. Apart from that, HDFC Bank itself, Niraj, you can come in on this one, contributes about 30-odd% to Bank Nifty. ICICI Bank was the only one that went home with marginal gains. That is worth a mention. Everything else was under pressure. iBank was up about 2-odd%, being one of the top gainers on the Nifty index as well. But very obviously, the sentiment of Bank Nifty is weighing on the index. You cannot be surprised. 35%, like I said, is the weightage that Bank Nifty has. And also, HDFC Bank's correction may continue today. So if you look at the ADR, there was some more selling on the New York Stock Exchange. Don't know what levels we're watching out for on HDFC Bank anymore, but for now, it still doesn't seem like it's finding a base or a bottom in that sense.
Yeah. Just before we move to stocks, the point yesterday also seemed to be that rate sensitives took it on the chin, because aside of banks, and only ICICI Bank went with the green, real estate, that index didn't have a single stock. You know, we have this contributors chart or the percentage move chart, and the Nifty Realty, if we pull that up just before we get to specific stocks, you will see a sea of red with, well, yes, Prestige led the way, but everything from a Prestige to a Macrotech to a DLF to
Oberoi was the big hit.
Everything right on your screen, and that just shows the pain yesterday in rate sensitive.
So it's also
ourselves with real estate. To be honest, actually numbers aren't looking great. While we did see that report in December, which looked amazing in terms of real estate sales, everyone that we've talked to has implied and indicated that cost of production or cost of building is still very expensive. So while numbers on the face of it look like there could be a recovery, I'm not sure how much of that is getting ahead of ourselves.
Yeah. No, the only point I was making on real estate before I hand it back to you, Samina, on stocks, is that look at Oberoi numbers. And, you know, I'll talk about Puravankara for a bit right now. It's now the reality check that comes in on the kind of run-up we've seen on real estate. And I think company by company will have to be seen very closely on whether they're delivering on what was promised. But I think the big story today undoubtedly is Axis, and that might end up being, sort of a relief over there, isn't it?
Don't know about a relief for now. The stock might be under some pressure, but we'll have to wait and see. Numbers are being viewed interestingly. So while brokerages are generally retaining their call on the counter, the likes of a Citi have actually reduced their price target. So just to take you through what we made of those numbers, largely a mixed bag. So in terms of the way you're reading it, profitability, tad in line with expectations. You had not too much disappointment. Deposit growth has been impressive, but the concern on deposit growth is that it's been led by non-retail. Now, that is chunky and not dependable. If you want to bet on great deposit growth, you've got to have it coming in from retail, which Axis Bank this quarter hasn't seen. NIMs are down, but again, not worth mentioning because that's an industry-wide average. There's nothing exceptional in terms of Axis Bank's NIMs either. Capital adequacy ratio now stands at 14% versus industry average, which is late teens. Does this mean there could be a fundraising plan around the corner for Axis Bank? Is anybody's guess, but that number is something that we have noticed at 14% capital adequacy. Doesn't seem too comfortable for Axis Bank. Provisioning was higher than expected. AIF provisioning was to the tune of 200 crores. So again, this is what we've seen from HDFC to Kotak to Axis, providing for that AIF piece, about 200 odd crores on this one. The stock has been one of the best performing banking names in the year. It's up 18% in the last 1 year, and I'm calling it one of the best performing banking names. So what you may see is a little bit of the gains getting petered off on Axis Bank. Brokerages, like I said, have maintained their calls, but they've reduced their target price. Citi specifically has actually lowered its target price on Axis Bank. They say, well, the numbers were slightly disappointing. The core trend remains intact for Axis Bank. So that's Axis. Havells as well, not very impressive numbers. The stock may see some selling pressure in early hours of trade. Revenue has come up about 6.9% versus our expectation. Margins are also up marginally. I've come in at about, actually, your EBITDA is up and margins have declined to 9.8 versus 10.26. There's been an increase in ad spends. Festive demand was below what the management internally had set out for itself. So some disappointment on Havells is what we are seeing. What I really want to talk about is United Spirits. Those numbers were actually fantastic, to say the least. Good set of numbers. Brokerages are seeming pleased. The counter could see some activity as well. Revenue was up 5.3%. EBITDA was up 30.8%. So that is one number that the street will be getting excited about. Margins have come in almost 300 basis points higher. So they've come in from 13.38 to 16.2. The reason is that United Spirits is focusing on premiumization, and their high-end or more expensive alcohol is the focus of the business, and that is what's actually kicking in the margin. So high-margin business, lower revenue, but margins are looking very, very impressive. Net profit has also come in higher. Conscious trend, I believe, consciously taken call by United Spirits to focus on premiumization. And I think this has really been the word on the street. It's luxury versus, not so luxury in that sense, right?
Yeah.
Rural versus urban argument is done with. The street is focusing on luxury. Those numbers are for everyone to see, where United Spirits has pulled it well. Great revenue, great margins, and a good festive season all in all.
Yeah, just to add just that one piece on United Spirits, rather two things. One, they have been on record saying that they want to get various forms of premium alcohol, tequilas, etc. into India. So one, that might be playing out. Two, the interesting thing is, and I think people are waiting for that on the con call today on United Spirits, that the 9-month EBITDA margin for United Spirits is around 16.2% or thereabouts. In the Q2 con call, they had guided for FY24 margins of 15%.
Oh.
So they're already at 16.2.
Yeah. They've overshot.
And if the ENA pressures are not too severe, and if they guide that, yes, we might actually do better than 15%, maybe 16, maybe higher, then that might actually be a trigger for the stock. So maybe the street preempts that today on open and then wait for the con call and do more. So I think that margin number that Samina is talking about, very, very crucial.
And coming from a segment that the business is bullish on. And yes, I guess as a nation as well. So
cheers to United Spirit. Definitely in that entire space, you're seeing consumables in the luxury segment, raise toast. Let's talk about a few others, because there are so many numbers that have been out. And frankly, we're not able to do justice to it in a short period of time, but some that stand out. Puravankara is one that I will talk about. Simply because of the focus in real estate, and those numbers on the face of it look good, robust, with an improvement in margins. Margins have gone up to about 34-35% versus 28%. Revenues are up 46%. Look at that EBITDA number, about 79% up. Board has also approved an interim dividend. There has been a change in their realization mix, in their product mix, where their affordable housing segment and that product has seen a little less realization, but clearly not too much of an impact to the bottom line, so to speak. KEI Industries is another one. The whole cable space has been under a lot of focus, and on the face of it, these numbers are not too bad. Revenues are up 15%, EBITDA up 19%. Margins have improved very, very marginally, but better than the Bloomberg estimate by a tad. Net profits are also up by about 17%. So largely, I would say in line. Also, piece of news with KEI, they've approved a voluntary liquidation of their Australia unit. So that's one to watch. Lupin, just the other one on my list. They've received a tentative approval for a drug called rivaroxaban, which is essentially to reduce stroke. It has a generic equivalent of a product that Janssen Pharmaceuticals makes, and a big market share for this product in the US, about $8,249 million. It's going to be manufactured at the Pithampur facility of the company. So these are a few. And pharma, anyway, has been seeing a defensive play. But anything that you're spotting this morning, Niraj?
Yeah, so a few others. So Airtel, a lot of talk around the prepayment of $1 billion of airwave dues. I just thought the MS note put this into perspective very well, and I'm therefore using that note's takeaway as the key for Airtel. Don't get too excited. They say that we believe that this will be positive on the NPV basis on the company over the tenor of the spectrum. Remember, Airtel has done this twice already in the last 12 to 18 months. But they say that assuming the yield on cash of 6 to 7%, this prepayment could help earnings by 1% for FY25. Remember, it doesn't do too much to the net debt because it's cash accruals and cash which has been used to pay this debt. So net debt doesn't get changed in any effective fashion. So don't get too excited on Airtel because of this news. That's the first piece. The stock may still react. I really doubt it will, but it may still react. Funny things happen. The second one, and we're going to be talking about oil and gas today on the editor's cut, but on Q, it's just coincidental that MGL has delivered what it has delivered. And I think the City note put this into perspective so well. So here's what they say. They maintain a buy, which is fine at the target price of 1480 or thereabouts. The takeaways. Solid Q3. EBITDA was up 75% YOY, 20% ahead of estimates. EBITDA being up 20% ahead of estimates, big thing. The beat in margins and the robust volume growth effectively helped the EBITDA performance, naturally so. And the 9-month EPS is at 104 versus FY23 full-year EPS of 80 rupees per share. More importantly, the piece that they've written about volumes at MGL, they say the volumes at 3.67 MMS CMD were led by a 6% growth in both CNG and domestic PNG, while industrial and commercial volumes also grew about 16%. Now, CNG growth in weight terms was even more impressive at 8% because, this is a relevant metric, of course, for MGL, considering that the gas consumed by MGL is richer in nature. They say that margins for MGL could remain supported in Q4 given the correction in spot LNG prices and MGL securing other gas supplies. Now, yesterday, we've seen Qatar and India sign a long-term agreement as well for supply of LNG. So things are improving on this front. It might be a tailwind for almost all companies within this pocket. Yesterday, we saw Petronet LNG, Aegis Logistics move up on this piece of news. MGL could well be another beneficiary. Last but not the least, maybe we spoke about Pidilite. Those numbers seem very, very impressive. But JSW Energy was the other one where the numbers seemed a bit off. For an expensive stock, it's imperative for it to deliver quarter after quarter. It's not quite done that this quarter somehow. Margins were okay. The PAT performance left a bit to be desired. Top-line numbers left a bit to be desired. Maybe, just maybe, a bit of a corrective move after the 5% cut yesterday. So that's to be watched out for as well.
Jeffrey's note on JSW Energy, though, just to add there, is not too negative. They rated it a buy with a price target of 600 rupees and are quite kicked about the higher merchant sales. They see power demand recovery also looking in. So we'll have to wait and see what happens with JSW Energy.
Yeah, that would, sorry, just Samina, just before, that will be the call for this year because, Prashant Jain, the ex-MD of JSW Energy, has gone on record that 2024 will be a year of power deficits in the country. So you'll probably see merchant power sales for all these companies do really well. But it's just such an expensive stock. Let's see what the verdict is today.
I think Pidilite, quick mention of Pidilite and Sona BLW. Again, two stocks that have managed to pull through very strong numbers. Niraj alluded to Pidilite. I'll just quickly take you through what those numbers are. The consolidated net profit came in at 511. That's up 66% year on year. Revenue from operations was up 4.4%. Margins, and I think that is what is shocking to say the least, have improved by 776 basis points YOY in the quarter. Revenue was aided by strong volume growth of 10% across categories and geographies. Growth was broad-based across consumer and bazaar segment and business to business as well. Both segments have reported double-digit earnings. So very, very strong. I'm pretty certain that the stock will see a big bump up in early hours of trade. Another quick one, definitely worth a mention, is Sona BLW. Again, fantastic numbers. Management has also indicated that this has been one of its best quarters ever. Very, very healthy order book, but let's take you through what those numbers are. Revenues at 776 crores, up 13%. EBITDA has come in 227 crores, up 22%. Margins have again improved substantially to come in at 29.26 versus 27.15. And your net profit also seems like a very impressive number, up 25%. So all in all, great set of numbers. Jefferies retains a buy price target of 750, and the stock and the company, of course, has an order book which at 24,000 crores, which is the highest in the history of Sona BLW. All geographies are recovering. It could be good going for this one too, guys.
Yeah, so before we move on to Editor's Cut, and I think we need to focus on Axis. That's the big story this morning as well, to see what those numbers are. I just want to bring on everyone's radar the results which are going to come today and which you need to watch out for. I think autos, two-wheelers will definitely be in focus. Bajaj, TVS numbers are expected to be decent this quarter. You're seeing that pickup in two-wheelers pan out. There's a positive note out on Hero as well. Indian Oil, I would mark out a bit of disappointment expected there. But since BFSI and banking is in focus, watch out for Canara and IOB as well. So those are some of the stocks and sectors which could fire today.
Tech Mahindra too, I think that's going to be the big one.
Yeah, post-market hours could be interesting for that one as well. Okay, the positions on Tech Mahindra, I must say, on the FNO side have been interesting to say the least. Resilient stock, but has seen some shorts coming up. But it's about time that we take the focus on to the Editor's Cut. And Alex, what do we have today?
It's going to be a power-packed segment, I think, Niraj. So let me very quickly set it up so that my colleagues can knock it out of the park. The first one has to be about the banking pack. You've seen earnings from all of the private sector banks in. And in fact, it can be said that this entire sell-off for the last 5 sessions or so has been led by the banking pack. HDFC Bank first, but that became more broad-based. The reasons why are what we're talking about at the start, and whether or not this is a problem primarily with HDFC Bank, or is it something that you can see in the signs of the earnings across the board as well. The second aspect is the delivery stats, because this is going to give you a perspective on how people are trading the stock as well. Yesterday's picture, of course, HDFC Bank delivery has been high, but what is the picture with the rest of the banks? And finally, we'll also talk about oil and gas. There was a sharp crack in quite a few of these stocks, particularly the city gas, no, not the city gas distributors, but for the oil companies, GAIL as well as ONGC. There was a crack. The question is, where do we go from here? Where do valuations stand at right now? And what are the key triggers? Hopefully, I've set it up well. Let's start, Vishy, with you. You've looked at the key numbers. Is it a trend across the board? What's playing out?
So a lot of it is playing out in the large private banking space at this point in time. What is happening is your HDFC Bank, Axis, ICICI, Kotak, IndusInd, all these big banks have come out with their numbers. What is coming out in the commentary is that people are not really excited with what they're hearing from the management. Essentially, the guidance that these private bank leaders are giving, it's not really adding much value in terms of future growth, the expectations for future growth. One thing that is specifically interesting in this cycle is that the better asset quality, that edge that the private banks had, that seems to be going away, because your public sector banks have already caught up with most of the asset quality gap that they had, the private banks. So that has been priced in. So what's left? Well, growth, and that growth is not looking so great. So if you look at where banks, large banks are guiding their credit for the year, most of the large banks have pointed out that eventually your deposit growth and advances growth are going to converge.
Yes.
What does that mean? Convergence, either your deposit growth picks up materially or your advances growth comes down. For deposit growth already in the system is at close to 18% year on year for these large banks. That's about 600 bips higher than where the rest of the system, 500 to 600 basis points higher than the rest of the system is. So room for it to go up further seems very limited. The only other alternative is that credit growth starts coming down and starts matching where deposit growth is, because you have to maintain that credit deposit ratio. The regulator seems to be uncomfortable with the way it's panning out in the system. And of course, that leads to unnecessary increase in cost of funds. So that's where the advances growth side is. The other thing is that margins are looking like they're going to compress for longer than previously expected. The expectation was that by the first quarter of FY25, you will see some sort of stabilization. In fact, some better banks may see improvement. That doesn't seem likely, because if the deposit repricing is still pending, then your margin compression is going to last longer. And the last bit is on the OPEX side. So there, again, a lot of banks are talking about branch network. They want to increase the footprint. Does that necessarily lead to better deposit growth or better business growth? The jury's still out there, because till last year, everybody was talking about how amazing digital is and that's going to push up business. Now they're back to the physical branch model. It's not clear whether the trade-off of higher expenses for the short term and then maybe better business later is going to play out yet. The expectation is that at least till September of 2024, you're going to see elevated expenses for major private banks.
Two questions on the asset quality. There's that one provision number for AIFs that stood across the board, barring one, I think. Yeah,
so actually the one that had the highest number on AIFs, which was ICICI Bank, is luckily the only one that did not see that big of a sell-off, because it sort of performed better than the others. Most other banks are reporting 150 to 200 crore between that in terms of provisions. ICICI Bank did not see any of that. They reported a 620 crore number, which was significantly higher. What these private banks are, however, saying is that none of this is because the assets are bad. This is because the regulation have changed, so we have to provide for it. But it's unlikely that we are going to actually report losses on those provisions. So eventually, as they unwind those investments, that money comes back to the profit.
Okay, and the last from my side, I'm sure that gentlemen have more to add, but the last from my side has to do with the capital adequacy. We saw Axis come off very substantially.
Yes.
Of course, that has to do with risk weights. Does that mean that banks will have to raise in the next couple of quarters?
So far, the commentary has been that we do not need more capital. We are still above the regulatory minimum. So, and of course, that is also feeding into the fear that growth may not be so sharp, because if you don't need to raise capital, obviously your growth is going to come up.
Which is an important point. Let's talk about delivery. And anything to add here? Okay, so let's talk about delivery, and that has stood out as very high over the course of the last few trading sessions.
Sure.
What was yesterday's number?
So I'll start off with the Bank Nifty, which has corrected about 7.5% from the top, from its lifetime highs. And in this same period, we have seen a correction largely on account of HDFC Bank. 7.5% is not a very large number. At 10% even, it's not a technical bear market. It comes in at around 20%. That said, at 10%, there will be a lot more caution as far as the banking index is concerned. On account of HDFC, we've seen a 15% correction from its earnings. About 30,000 crores of delivery-based buying in HDFC Bank since the day it came out with its earnings, including 5,500 crores worth of delivery-based selling yesterday. So it is substantial. That's nearly $3.5 billion. And just if, this is a very rough way of comparing, but since over the past 5 days, FII selling has been worth around 28,000 crores.
Correct.
Of course, this is not a like-to-like comparison, because in HDFC, you don't just have FII sellers. We also have domestic institutions and retail participation as well. That said, in terms of the numbers yesterday, we are looking at substantially higher delivery numbers for all the banks. So HDFC consistently at 65% delivery number coming through. But even for something like an ICICI Bank, of course, that was the only private sector bank which advanced. But say for that, well, we had about 60, anywhere between 55 to 65% delivery numbers coming in yesterday as well, which means that should we see more selling coming through, there's a likelihood that the Bank Nifty, not immediately, but over the span of the next few weeks, could correct as much as 10% from the top.
Understood. Niraj, you want to add anything to that, or you want to jump straight to the...
No, this is comprehensive enough.
It's
so
comprehensive.
Let's move on to oil
Let's
and gas.
talk about oil and gas. And
Yeah.
I think the basic question is, where do we go from here and what are the key triggers?
Answer is who knows. But, but be that as it may, we just thought we'll take a look at the valuations a little bit, right? So the cue also came from the fact that yesterday there was this LNG deal signed between Qatar and India, and Petronet and some of the others did very well. Could OMCs and some of the others follow suit? Because city gas distributors have done well. I'll come to them at the end. I'll start off with ONGC and Oil India, the upstream players. Now, the valuations currently FY25 basis, 0.8 to 1. Actually, Oil India is slightly cheaper than ONGC, but 0.8 to 1 times 1. FY25 expected price to book. We moved to FY25. Everybody's actually, some people are FY26 also, but let's avoid that. FY25, right? This is about 20 to 40 odd % below mean, depending on what's the time period that you take, and depending on what estimates do you take, people assign to these stocks per se generally, and they are trading at an attractive dividend yield of about 6%. Now, under any market, no matter how strong it is, 6% dividend yield is somewhere where PSUs see buying. This traditionally used to be the sweet spot for REC PSU, as you guys would remember. 6% dividend yield, okay, people would say, okay, hey, this is great. So ONGC, All India are now trading there. And unlike the OMCs, which have this hangover of marketing margin-led gains, but whatever, if the price cuts that come in, upstream doesn't have that problem. Sure, in the past, they've been saddled with putting in some money where the government might need it, but let's leave that aside for now. So the valuations, the dividend yield, etc., not too bad. Therefore, could they see a bounce back? Maybe. The other one is GAIL. You know, Petronet and some of the others have rallied because of this drop in LNG prices. GAIL hasn't. GAIL is a beneficiary out there too. So you just compare what GAIL has done versus what some of the others have done. GAIL has hardly had a move. Now, also in terms of valuations, at the question that I ask is for GAIL, at FY25 of what, 12 or FY26, 10p, is GAIL really expensive? And if not, what is ailing GAIL? You know, that's the question that comes to mind. Not too much. The recent performance has been pretty decent. This cut in LNG prices could help GAIL. So that's the other one to focus on. City gas distributors, MGL today, the results, as all of us have seen, would probably work for the stock, right, today. But the larger point is that lower LNG prices at large augur very well for some of these businesses. And LNG prices have come off about 40-45%. The back of the envelope calculations that brokerages have done is that a 50% drop in LNG prices would mean nearly a 25 to 30% expansion in earnings for these companies. Have we seen that kind of a price rise? We haven't. So could we see that? Who knows? But the market is in a corrective move, so it's stupid to make a bullish argument right now. But, you know, there is an argument to be made here. And lastly, Petronet. I mean, yesterday, you know, it's a beneficiary of lower spot LNG prices. And yesterday, there's this deal signed. The stock was up 5%. Could it do more? Maybe. Could allied places like Aegis Logistics, for example, do more because they are large in LNG terminals? So, you know, all of those come into play, primarily because the stocks didn't rally too much and there has been a bit of a correction.
Fantastic.
Just a quick note on an S&P Global note which came out recently in the last 4-5 days. And they were talking about capacities for upstream oil companies. And they have mentioned that while they have promised a certain capacity, S&P Global believes that those capacities will not be fully on stream at least this year, which means there could in fact be a supply constraint, and that could in fact also lead to higher prices as far as their products are concerned, which well, eventually could land up benefiting these companies themselves. So that's another point to perhaps ponder upon.
Yeah,
clearly.
certainly.
All right, so I think we've kind of had a comprehensive conversation about both the banking space as well as oil and gas. Let us know what you think in the comment section on any one of our social media platforms. Meanwhile, we have to set you up for the day's trade, and there's lots to talk about on the F&O side as well. So do stay tuned. We'll be back before you know it.
Welcome back. We're gearing up for trade this morning. It looks like it's going to be a flat to higher start in early trade. But first up, a quick check on the top headlines that we track. Banking stocks witness a fresh wave of selling, drag the rest of the markets down and wipe out 8.5 lakh crores. Axis Bank reports over 9% rise in income, but expenses eat into profits. And Z Entertainment loses a third of its value as institutions dump the stock after merger talks collapse. Bharti Airtel will be in focus after the company prepays 8,325 crore rupees towards spectrum fee dues. And US equities continue to gain. S&P 500 notches third straight day in a row to close at a record high, while the Nasdaq also climbs 0.4%. Dow, on the other hand, falls 0.25%. Well, those are the top headlines, but it's over to Agam, as always, for the F&O action. Agam, it's looking like an exciting morning.
Well, one can only hope, based on what we've seen, because yesterday was a terrible disappointment as far as bulls were concerned. And, well, we saw how things panned out. So let's start off with the benchmarks. Of course, the Nifty did come off substantially. It did come up around 1.5%. This, of course, is January futures. And naturally, we will have unwinding because we are now in expiry weeks. So let's pull up the February futures too. Open interest declined to the tune of about 157,000 shares. But even in February futures, the open interest did not go up as much, which means on a net basis, we have seen a decline in OI. That also means that a lot of traders still are not very confident of putting their bets as far as the benchmarks go, at least as far as the Nifty is concerned. Talking about the Bank Nifty futures, remember that the Bank Nifty futures is also going at a discount. It came out by 2.25% yesterday, and open interest, very little change there, about 127,000 contracts as far as the February futures go. And that's where, once again, we haven't had as much interest building in. Of course, we still have two very long sessions, perhaps, as far as your expiry is concerned. So unwinding overall on a net basis coming in there as well. But now, Bank Nifty is at around 45,000. It's kind of a psychological zone. And if we do break this, you never know where the Bank Nifty could go. Let's talk about the options market then. And on expected lines, we saw a lot of writing in terms of calls and a lot of unwinding in terms of puts. If you look at this from a writer's point of view. And, well, the 22,000 mark is completely out of the picture. And, in fact, we are now seeing 21,700, 21,800 also being taken completely out of the picture. At the moment, things do seem bearish, but it doesn't mean that we couldn't see a bout of short covering and perhaps consequent consolidation coming through after that. Of course, this is as far as your OI distribution picture is concerned, as I was talking to you about earlier. But now the lower end of the spectrum is now 21,000 based on maximum open interest in puts. And that's as far as your Nifty is concerned and how things are placed. The question really is, what do you do with this data? And can you, in fact, take advantage of the bout of the increase in volatility that you've seen of late? Let's find out. Let's get an expert opinion. We have Amit Goel, a market expert, who's joining us on the show. Amit, good morning, and thanks so much for taking the time out. Let's start off with your view on the benchmarks. How are you placed here?
Good morning, Agam. Good morning, everyone. Yeah, yesterday was a bad day for the books. We have had an exceptional sell-off. And the interesting point to note here is, this is not a global sell-off. Whatever we have had is more localized, more event-driven, news-driven. It could be HDFC Bank, it could be Z Entertainment, and it could be some bit of profit booking in the PSU stocks. So while there has been a sharp bout of selling, that has already been done. Now the next step of action would be, what next from here? So my intention or my reading of the chart is we are in a proper range now with the ATM PCR being close to 0.9, which indicates a more balanced approach for the next week. And overall sentiment has turned a little bearish because on the charts it's lower high, lower low formation. So while positionally speaking, we would look to sell on rise, but from a short window of a week or so, as a trader, one could look at set up a range bound trade or consolidation trade, given that the implied volatilities are elevated right now, So I feel that one could approach Nifty from a non-directional perspective for the next week if the market settles around 21,200, 21,150 in the first 1 hour or so. Speaking about Bank Nifty, that is the culprit. That is the more weaker, and it's quite obvious. Interesting point to note is Bank Nifty has already given up all the December gains, all the January gains that we have made in the last 2 months, and it is now trading at the low of the starting of December at 45,000. This also happens to be a very important psychological mark. So there is a silver lining here that maybe the bout of selling is probably done here, and we might find some bit of support at around 44,500 and possibly 44,000, where the weekly super trend lies.
So based on that, Amit, how are you placed as far as the Nifty is concerned? How are you strategizing? What structures are you playing on it?
Yeah, the structure is very simple. What I would look to do is I would not chase the open either on the upside or the downside. If the market settles in the range of 21,200 and 150, I have identified a range of 21,500 to 600 on the upside and 20,750 on the downside, and initiate iron condor for the next week's expiry. Remember that the budget is on the expiry day, which is I think on the 1st of February, which happens to be Thursday. So we could take benefit of this consolidation expectation and set up an iron condor by selling the 20,700 put and the 21,600 call on the upside. Obviously, this is a short strangle, and we would want to protect our exposure and cover it up with buying the hedges at 22,000 a call and 20,300 put.
I've lost him. Right. Amit, I believe you also have a view on Apollo Hospitals. Can you take us through that one?
Apollo Hospitals chart and its price action yesterday, while it was news driven and it opened with a very sharp gap up, it gave away the entire gains of the day, and the structure that it has formed at an overbought level is that of a counter-attack pattern, and it's a fairly bearish structure. So what I would like to initiate here is, if Apollo Hospital comes up a little bit at say 6,200 levels, I would like to initiate a bear call spread, which is a bearish strategy given the high levels of implied volatility. And I would like to sell the 6,300 call of February expiry and buy the hedge at 6,500 call. The risk here is if the price closes above 6,300 levels on closing basis on the hourly time frame, I would close the trade and probably incur a loss of 2,000. But if the trade works in our favor as a mean reversion setup, we would like to, we are looking at a profit of about 9,000 rupees.
Okay. Amit, we'll leave it at that. Thanks so much for taking the time out and being with us today and giving us those thoughts, but need to address those flashes on your screen. Now, yesterday, we discussed this in a trade setup that non-extension was anticipated, but yesterday, a few stories had spoken about very large numbers that could be impacted as a result of non-extension of the FPI window that was spoken about in a story yesterday in one of the publications. Now, as per sources, the estimates were vastly exaggerated in conversation yesterday. We'll get in Sajid in a moment from now, but sources are saying that, excuse me, sources are saying that FPIs are required to provide enhanced disclosures expected to be significantly less than anticipated. So one, the quantum of disclosures, not very high. Certain categories of investors are exempted as well. Pooled investments exempted as well. So if you look at a clutch of these moves, it seems that the impact, if any, in the minds of some of the investors that may have been as well, was estimated to be vastly higher than what the actual numbers could be as well. And a clutch of FPI categories anyways exempt. So therefore, there is if there was fear yesterday, and to be honest, a few people that we spoke to said that it may be coincidental. It was not necessarily the trigger. But even if you assume that that could have been one of the triggers that led to the selling and the fear around markets, that need not necessarily be the actual case. Guys, this is a good disclosure, and we'll get in Sajid because Sajid has put out this piece as a source is saying. We'll get in Sajid to talk about this more. But even if this was the overarching reason, the fears are not as much as was believed to be the case yesterday.
I think the key line also, while Sajid is miking up, is that there is no immediate deadline or cliff for FPIs to liquidate any holdings. And if you recall yesterday while we were doing the closing show, Gurmeet Chadda was talking about this concern that came in. That could have been one of the reasons we saw an enhanced amount of selling towards the close of markets, where that concern was coming in about having to liquidate some positions before the 1st of Feb. So an important piece of news there, which is coming in, that that enhanced disclosure requirement is not as bad as it was thought, significantly less than estimated, in fact. Sajid here in the studios with us. Sajid, set the context of why this is such an important iteration coming in.
So, it was there was a consultation paper with respect to ultimate beneficial ownership. The genesis was prior to the Hindenburg, that SEBI was trying to figure out who are the FPIs who are investing in the Indian market and whether there are concentrated risks which is there. And with that respect, there was a consultation paper which was put in place, which basically said that if 50% of your AUM or if your asset under management in India is more than 25,000 crores, you will have to give us the ultimate beneficial ownership of people who are holding it. The board has approved it. And then they said they will come out with an SOP which will be brought in by the custodians, which is deemed depository participants for all the FPIs, which is there. The SOP will set out the entire stuff with respect to what kind of exemptions will be allowed to various FPIs. So at the time of when the board note was released and the consultation was done, it was roughly around 3 lakh odd crores of money, or which was high risk money which was there. That's what SEBI estimated at that point in time. At that time the total AUM was 45 lakh crores. That for FPIs together. Today it's around 61 lakh crores. Okay. Now SEBI sources are telling us that the entire that quantum is much lower than what was anticipated in the SEBI paper. There it was anticipated that roughly 2.2 lakh odd crores was part of the 50% AUM which was invested in India, and 70,000 or 75,000 odd crores was because of belonging to FPIs which had more than 25,000 crores exposure in India. So when all the FPIs came into the picture and when custodians went back, because there was an SOP formed how you will do it. At that point in time, SEBI has been in constant touch with the custodians, and many exemptions were provided. Like if you're a sovereign wealth fund, you will not be allowed. You don't need to do it. If you're a public retail fund, you don't have to do it. If you are a fund which is listed in an overseas jurisdiction, like many mutual funds are listed in US market and governed by the SEC, then you don't need to do it. The apprehension was that there are funds which are pooled in nature, but within the funds there are separate class of instruments which are there. So X person comes in the fund and says puts $100 million, he gets a separate class of instrument, though it's a pooled fund. That $100 million is invested in the companies which he wants to. So SEBI wanted...
It's too much data, Sajid.
It is too much data.
Simplify this.
To simplify it, that there is no risk from pooled investment as of today.
So AIF category 1, category 2, category 3 have no risk for FPIs. Fair to say?
That is fair to say. Means any FPI
hedge
coming
fund,
through a hedge
fund or AIF?
You have to follow the funnel of exemptions. Wherever exemptions you don't have, you don't get into an exemption, you have to give a disclosure. And that what is more is that, as Tamanna was mentioning just before, that there's some liquidation
Sell-off.
fears which
Yeah.
are coming in, right? So October to Jan end is the time when they have to disclose everything. That disclosure period is not over yet. It gets over by Feb 1st. After that, they have 10 days if they fall under the 50% category, and 30 days if they fall under the 25,000 crore category. So it will go up to middle of March. But they have been given 6 months time to bring down the positions.
Okay. So a little more, the deadline is a little easier. But just give us a sense of the quantum of funds which will be impacted. Of that FPI figure, even with this easier deadline.
That number isn't out there, right? It's
Do we
lower
have
than
a
45,000 crores, but not out there.
60,000 crores is if the total, then yeah, half of that.
No,
right?
no. 50,000 crores, 50%. 50%. There are two criteria. 50% of your AUM if it's invested in India, or 25,000 crores of total amount, absolute amount invested in India. If you break that up, it's 2.2 lakh crores which falls under the first category, and nearly 75,000 crores that falls under the second category. Now, after the exemptions have been removed, the amount is much more smaller.
So all in all, this is
there is no
good
systemic
news.
risk. There is no systemic risk as the market was saying.
Was anticipating.
So
significantly lower.
And sources are saying that none of the FIs or FPIs have sold because of this as of today.
Got it.
So the fear of liquidation.
How would you know intent? How would you know intent? I mean, there could be a number of reasons, but how would...
Yeah, the point is that,
intent?
sources are saying that we haven't seen any kind of
abnormal
selling or changes, because any selling by the said things have to be disclosed to the custodian, and through the custodian to the regulator immediately.
So calming, reassuring sort of messaging coming in here, I think that's the important thing.
Yes, it basically means that the risk is not there, and there is no cliff that tomorrow everyone is going to sell. It's not. There is 6 months period to, if you fall into that category, you have 6 months period to ease off.
Right. Okay, well, Sajid, stay on. What we need to do is we need to slip into a very quick break, and on the other side of the break, we are going to get our experts to try and probe more about the nature of the trade today. But keep in mind, this is a small positive or a big positive, depending on which way of the trade you were at, if you believe this was the big news. We'll talk more about this and more with our experts on the other side of this very quick break. Stay tuned. Chandan Taparia, Head of Technicals and Derivative Research at Motilal, as well as Mayuresh Joshi, Head of Equity Research at William O'Neill, joins us on the other side.
Welcome back. You're watching India Market Open. Let's take a quick look at the implied open. It's going to be an interesting morning. Are we going to see a recovery? Are we going to see further pressure in banks? Axis Bank numbers on the face of it look decent. Is that going to be rewarded? Implied open showing maybe a bit of a positive start. Chandan Taparia and Mayuresh Joshi now joining us on the show for their take on markets. Mayuresh, I just want to begin with any commentary if you have to the big story that we've broken on NDTV Profit just a few minutes ago. Sajid is here with us. You would have heard him, where there seems to be a clarification from sources that there's no immediate threat to FPI investments in the market. This concern about a deadline seems to have eased. Any comments on that or your take on that? Is this going to be a big relief?
Morning, Tamanna. I think the better part of the market rumors that were moving around yesterday was surrounded by this piece of news. And what Sajid was just mentioning, I think that will be a big relief for the markets. Because if expectations are to be believed, and if sources are to be believed, if this is the case in scenario, I think the implied risk that the market probably had for a sharp sell-off that can probably come through because of liquidation, that probably goes away. So I think that allays the fears that most investors would have on the street. So yeah, I think if this turns out to be true, it's a big relief for the markets.
Chandan, just very quickly, let's get your check and take on the levels, because we had a bit of a brutal closing yesterday. Are you seeing any signs of recovery on the Nifty and the Bank Nifty, which took the big hit?
Hi, good morning. Thanks for having me. So yesterday we opened higher but failed to hold it higher, and index witnessed sustained selling pressure for most part of the day. It corrected by around 500 points from its high level, and bounce are being sold. Recently, we have noticed negative divergence, so that is working. So we believe that till it holds below 21,400, 21,500 zone, some more profit booking decline could be seen in the index towards 21,000 to 20,850. So we'll go with sell on bounce with the view that upside is kept. Some more profit booking decline could be there in the broader market.
Okay. Chandan, quickly, banks looked very wobbly yesterday. Is there a banking name or a trade on the Bank Nifty, HDFC Bank, ICICI, what have you?
Yeah, so talking about banking name or Bank Nifty that is comparatively underperforming, and the major selling started with the weakness in counter like SDFC Bank. We have seen some sort of resilience in ICICI Bank and Axis Bank, but again, the follow-up is totally missing. So first, if I talk about the Bank Nifty, we believe that here its structure is weak. It is holding well below its 50-day exponential moving average. So till it remains below 45,500, sell on bounce could continue to us downside move 44,444. If I talk about SDFC Bank, weakness is continuously there, and we have expiry, and the stock is trading below volume weighted average, so weakness could continue. So now only hope is put writing of 1400 could provide as a support. So as of now, weakness could be there towards 1400. Talking about as ICICI Bank, comparatively okay, witness some cool down from high. So with support of 995, one can attempt towards 1060. So comparatively, ICICI Bank is okay, but Bank Nifty, SDFC Bank, all others showing weakness, and further decline could be there in these stocks as well.
Okay. Well, we'll watch out. The pre-open rates will be all over the place, but I think the moot point today may be not just what happens to the banks, but a clutch of names which have come out with a very good set of numbers, and I think we'll talk about all of these during the course of the next 15 minutes as well. We'll wait for these rates to settle before we talk more about them. Fundamentally, Mayuresh, coming on some of these oil and gas names, and particularly the city gas distributors, MGL numbers show that volume growth, margins, all are supportive. LNG prices cool off might actually aid too. So what's the call here on MGL and the other gas distributors?
Morning, Niraj. So I think a couple of factors at play here. One, the expectations. The expectations in terms of volume growth over the next few quarters and years is expected to be relatively better, because the government target itself is to take this share of the market from 6% to 15%. So I think more geographical areas will obviously come through, and therefore I think over a longer period of time, structurally, volume growth should be decent. The second aspect remains largely in terms of intermittent results, which depend a lot in terms of demand-supply dynamics, how pricing is expected to be, how input costs will behave. and therefore how operating metrics, specifically EBITDA per SEM, will probably move. So from an intermittent short-term perspective, there might be some amount of volatility as far as these variables are concerned. But structurally, I think the story remains extremely solid over the next few years. MGL, I just saw your morning note, Niraj. Yes, very well put out in terms of how numbers have come out and how numbers will be perceived by the street. So anybody holding on to these stocks can hold on, but you have to have that amount of disclaimer that from an immediate short-term perspective, there might be some amount of volatility as far as numbers are concerned.
Chandan, would you still consider shorting Z?
So this name is very volatile. Actually, the structure is weak, so there is no worry about selling. But only problem is the risk reward ratio might not favor. So what we advise that you can go in option side, however premium is high, and tomorrow is monthly expiry. So you can go with next month expiry. Again, stock usually comes with FN of Bain, so that is also concern. But yes, its structure is weak. If you ask me the advisor, then I can suggest that stock can further drip down towards 140, 135 levels.
Chandan, we're gearing up for market opening, of course, still starting off on pre-open. Very quickly, your top trades this morning, any recommendations on the long or short side?
Yeah, I'll mix with the long and short, both given the market scenario. Bharti Airtel is one trade where we have positive view. The stock is continuously making higher tops, higher bottom, supports are gradually shifting higher. We have seen delivery volume and rollovers are better comparatively. So one can buy Bharti Airtel with support of 1135. It can head towards 1200 to 1215 level. Selling idea there is on Kenfin Home. Structure is weak given the breakdown. The stock is usually having a range bound manner, but the way it has seen sharp selling in last 2 days, indicating further decline could be in the card. So Kenfin Home can be sold with stop loss of 738. Here we are expecting a downside move towards 700.
Chandan, just your take on banks and pre-open. You're seeing another weekday, at least lined up for HDFC and Axis, Kotak Mahindra, all of them seeing a bit of pain, at least in pre-open. We'll see how that pans out, though. But any kind of support you're seeing at all for HDFC over here?
So only support is now expiry. Let the expiry settle. Then only we can understand that how much position is being carried to the next series. As of now, only support is put writing of 1400. So there is the next level near 1385 to 1400. So when stock is falling down, we should not look at the support. Let's look at the resistance. If any immediate resistance is surpassed, then only we'll get the sign of stability. So look at the 1400 below as a support, and if it moves above 1500, then only talk about some positive thing in SDFC Bank. This is how we need to work on SDFC Bank.
So HDFC Bank looking iffy. Mayuresh, any view on Axis? Clutch of brokerages this morning, not too negative. I mean, Citi has a buy, Jefferies has a buy, HSBC also has retained their buy on Axis. So pre-open, the mood seems very, very different. What would you do with private sector banks right now?
So I think decent set of numbers. And in fact, Tamanna, even ICICI Bank had a very decent set as far as most of the parameters are concerned. IndusInd might be a little bit soft, but again, I think a large part of the banking universe, specifically the large private banks, barring HDFC Bank, have posted a reasonable and a decent set of numbers. Obviously, their counterparts, mid-cap and mid-tier PSU banks, have performed relatively better. And therefore, the skew in favor of mid-cap PSU banks, both in terms of risk reward and expectations of reasonable growth going forward, still continues. As we see it on the O'Neill lens, a few of the PSU banks, like Bank of Maharashtra, probably look very, very attractive even at this juncture. From a valuation perspective and from a placement perspective as far as pivot levels are concerned. Large private banks, we continue to have our hold recommendations on both ICICI and Axis.
Mayuresh, couple of other earnings that worth a mention. Pidilite, very, very solid quarter from Pidilite. Top line, margin, substantial improvement. Apart from that, Sona, BLW, I don't know if you track this one, again, exceptional numbers, margin improvement, order book at record highs, geography is looking good. And I'm going to throw in a large one as well into that mix, which is United Spirits. Stand out because of what they've also done on the margin front. Amongst the three that I've highlighted, anything that you would consider adding to your portfolio this morning?
So I think United Spirits, Samina, might keep the spirits high for the market today because markets really need that. And solid set of numbers. So again, I think the expectations largely from United Spirits in terms of more products being introduced, specifically the premiumization products, is going to be very, very helpful in aiding both their top-line-led volume growth as well as margins going ahead as well. Input costs have definitely moderated, and to that extent, the expectations in terms of stable margins going forward is something that the street believes can continue. So United Spirit is something that I'll watch out for, as well as Pidilite. In my opinion, again, I think Fevicol ka Majboot Jod, I think those numbers are probably getting reflected both in terms of volume growth, super margins. I think they did not just beat the estimates, but I think the margin delivery was far, far better than what anybody expected off the street. Now, the large part of expectations here, again, is more products being introduced, more value-added products to a large extent. And the kind of investments that they have been doing over the past few quarters in terms of new products expected to come into the market, I think that will start yielding results through their distribution change and the brand that they've got, through the master brands that they probably carry into the market. So I think both United Spirits and Pidilite, solid set of numbers, expect good moves here going forward as well.
Right. And then on the charts, do they look as good? Pidilite indicating to a 4% gap up. United Spirits as well, like Mayuresh said, will keep the spirits of the markets high today. And throw in Sona as well. All those three companies on the charts looking like a good trade anyway, yeah?
Yeah, so yes, I also agree that the spirit is high as we're heading towards month end and weekend. So I agree to the McDowell view. Positive setup, and taking the counter from last couple of months. Earlier it used to find hurdle at 11.25 and hold above the same will open the further upside of 5-7%. So one can buy. As per the previous closing, support will be around 1100 and it can head towards 1160 to 1180 levels. Talking about Pidilite, again, we believe that if market turns volatile, then such name usually comes in support, but that is not visible. Pressure is clearly seen in the counter, so look at some more weakness. It can drip lower further from current zone.
Pre-open rates have settled. I want to mark HDFC Bank and just see what has that stock done in the first 8 minutes. I reckon it started off or looking to start off lower, and I think that is the pain point. Pull up HDFC Bank, the pre-open rates. 1380, the stock looked valuable at 1600, looked great value at 1500, then corrected all the way to 1427 yesterday, and currently 1380. If you were looking for one pain point for the market, it is HDFC Bank.
I'm adding access to your list. 5% down
5%
in
down.
pre-open.
Yeah, well,
so all your numbers were not bad. I don't know what.
Maybe not up to the mark.
Reaction is.
And by the way, this is after Axis Bank having a significant corrective move already in the last 2 days as well. So there is clearly a problem here. Now, Mayuresh, maybe fundamental. Okay, actually, let's get this fundamental thing going, right? HDFC Bank, India's biggest bank, certainly very valuable, great price, great value, price to book relative to averages. It's not seeing buying. Are you a buyer?
No. And the logic is very simple. Exactly. The logic is very simple. I think what the street is expecting and what the bank is delivering, Niraj, I think there is a huge expectation mismatch. Now, at some point, right, considering HDFC Bank's base, there is going to be some amount of stability that will come through. Obviously, the bank has mentioned they are not going to chase growth for the heck of chasing growth. So they're going to be very, very cautious when it comes to both deposit mobilization as well as the advances growth. As a trend for the industry as a whole, the risk-weighted assets have gone up significantly as a percentage of total assets. With the conservative management that we probably got, the expectation largely is that over the next couple of quarters, to say the least, the bank will keep on continuing a very stable show on what it has delivered in Q3. So to that extent, expecting an earnings turnaround happening in Q4 or Q1 probably looks very, very bleak. At the same time, if you do a comparison check for mid-cap PSU banks, and I might be a little bit biased here, but I think the logic here, Niraj, is again, a large part of the pooled universe, the customers that PSU banks have got are ex-bankers, pensioners who depend on the bank in terms of their deposit mobilization as well. So even if NIMs might be a tad bit lower than the larger private banks, the accretion or the acceleration in terms of deposit and advances growth are pretty robust as well as valuations. So to that extent, my sense is that it might just be an underperformer. Some point of time in the next couple of quarters, there might be a buying opportunity. Not right now.
And that's exactly what I want to ask you. It's all about risk reward. At what stage does HDFC start looking attractive? I mean, the way it's fallen is almost nerve-wracking. It's not an expensive bank. Sure, there could be a little bit of a disconnect between what the street was looking for and what the bank is delivering. But at no point had the bank also overcommitted in such a big way that we are punishing the stock to this level. And let's not forget, there is history. There is the fact that this has been a solid bank for many, many decades to come, or decades behind us, rather. At what price would you buy HDFC? 1,300, 1,350, 1,250, 1,200? Put it out there.
So strategy, we are growth investors, Samina. So I think I need a price change to happen on the positive side. So my own sense is that at some point of time in the coming quarter, as the selling pressure gets off, most institutions, there are a huge amount of institutions in HDFC Bank as well. As they start throwing in the towel that nothing will probably happen, I think at some point of time it will bottom out and start showing a price rise. And that happens, I think, if it crosses. And our own sense is that we look at pivot levels and growth levels as well. So it has to cross that 1,500, 1,550 mark. Unless it does that, I think that supply pressure will continue on the bank.
Okay. Chandan, just a couple of minutes to close. Let's get an idea of what you're constructive on in today's market. You've given us your picks, but what are the spaces where you would look for opportunity? Do you think IT, pharma, maybe some of those plays are still showing promise?
Yeah, like in indices, we need to look at sell and bounce systems with the view that further we may see profit booking decline. But yes, selective stocks could do well. So definitely I'll go with IT name, or can select selective pharma. So we, even on the last trading session when entire market was falling down, selective pharma stocks are holding well. And that is the reason that I selected one pick, Bharti Airtel, as a being low beta in the upmost side. So yes, accordingly in the same theme, Cipla we can focus. Any decline towards 1400 could be bought with support of 1385 and stock can head towards 1440. So I can select Cipla from your pharma basket. BSoft will be other name in IT basket where trend is positive. Every small decline could be bought. One can buy with support of 780. It can head towards 835. So BSoft, Cipla, Bharti, these are the couple of names which can see resilience and generating alpha with some outperformance in the market.
Indeed. Just take you through a few stocks that will be in focus. Interestingly, Z, after a 30% fall yesterday, is expected to see a flat start. Your gainers are your usual suspects that have posted strong earnings: Pidilite, Sona BLW, Mahanagar, L&T Finance Holdings. All these counters in focus on back of earnings. Tata Elxsi, Axis Bank getting a thumbs down post-reporting. Chandan, we only actually have 50 seconds, Niraj, so I'm going to quickly toss it to you. But from the face of it, it's looking like it's going to be a half-decent start. Axis Bank will put some pressure again on the index along with HDFC Bank. Be interesting to see how SBI also reacts in today's trade.
Most certainly, Samina. The pocket that we will also talk about is this whole renewable pocket that we marked yesterday. Waaree Renewables is up 5% in the pre-open session yet again. Adani Green is in the green this morning as well. And must say, for all the pain that we've seen in the markets, Adani Enterprises, it's an index stock, has stood rock solid at that 2900 mark as well. So it's pretty interesting as to what's happening in some of the individual pockets. But the first trades this Wednesday morning on your screen. We'll start off with a mild negative courtesy banks. The bank Nifty will be deeper in the red, I would reckon. The Nifty is trying to claw its way back. The bank Nifty certainly down there. Mid caps and small caps very quickly before we get the heat map. Flat for the mid cap index, flat for the small caps, yes. And this is because of the two stocks at the bottom of the heap here on the heat map. HDFC Bank and Axis Bank will come up on your screen right here. Axis Bank 3.5, HDFC Bank not as bad as the pre-open was suggesting, by the way. And in fact, HDFC Bank seems to be clawing its way back just about 1% or less than 1% now. Airtel on cue. It was not a big announcement, that prepayment, hardly any difference. The stock was up 3% yesterday, giving back some of its gains. What's done well? Some gains for Hindalco. Well, metals have had a belated rally. There is some excitement towards Chinese markets yesterday. China did well yesterday. And some policy moves, maybe that is aiding a belated move on Hindalco. I could see no other reason. Maybe I'm wrong, but let's wait and watch. Is there something else on the large cap end that is Reacting to numbers or news, not really. Reliance is flat, Infi is about 1%. So yes, IT seems to be resilient. We spoke about this, and that resilience is visible here because Infi, LTI, HCL Tech, Wipro are amongst the key movers on the session. Axis, clearly the main culprit, and HDFC Bank trying to fight its way back. Tamanna, what are the broader end of the spectrum?
Well, we'll pick the stocks that you may see a reaction here, but I would just add that look at your auto pack, also feeling the pressure ahead of some key numbers today, and Hero Moto feeling the heat. But let's look at other stocks that may react to news today, and we'll pick Havells to go first. A bit of pressure on margins that has been seen in Havells. Your rural demand continues to be muted, although your revenues are up 7%. That stock about 2% down. JSW Energy, again, the numbers on the face of it looked decent. Jefferies has a buy call at 600 as well, but the stock not doing too much this morning. Sona BLW, another one that we should look at, and that's up in the green. Again, a buy call from Jefferies on their numbers with a target of 750, so quite an upside over there, and that's showing some spot of relief. AU Small Finance Bank is the other one I would look at. AU Small Finance Bank had some news coming in where they received approval to merge with FinCare, but that entire pressure on the banking space panning out here as well. And let's take a look at Lupin. Lupin is something that we put on our list, and Lupin showing some positive signs over there. They've received approval for a generic drug that works in preventing strokes. So these are some of the stocks that are on the radar, but of course a lot more that are showing action this morning.
Lots of other stocks that are catching my attention. I'm going to mention some of the top gainers, Tamanna, from the broader markets. And Z, after that big fall yesterday, is actually up this morning. Almost 6% gain playing out on Z Entertainment, up to about levels of 165 rupees. Pidilite, I'm not sure if that was mentioned, but again, a quick word on that one. Really solid earnings. The stock is up 4% in trade. Well, you've also got a few other counters that are trading well. So some of your media names that got beaten out of style yesterday after the Z debacle are seeing on finding their feet this morning. So TV 18 is up marginally. Network 18 is up about 1.5 to 2%. Not doing too badly in early hours of trade. Some of your other counters worth mentioning is Borosil Renewables. After a very sharp run-up yesterday on back of those solar renewable energy push that we saw on that sector, is trading flat. So after 15% up move, the stock is lower. Niraj indicated Vari is actually having another very pleasant morning. So I'll quickly pull up that one to see what's happening on the stock. It's another 5% up move from what I understand on Vari Renewables. So both those counters looking good on the gaining side. On the sell side, Railway was a weak spot in trade after many days of doing quite well. So Rail Vikas Nigam is down 7% this morning. Pull up IRFC, IRCTC, because these are stocks that have really ran up significantly in trade, and IRCTC, after a 400% up move over the last few months, saw a big correction yesterday, down another 1.5%. IRFC is also down about 5%. IRFC, in fact, IRFC is the one that has been leading the gains recently. Is down about another 6% in trade this morning. Well, real estate is weak again. Oberoi is down 5%. Prestige is down 5%. Sobha is down about 5% Tata Elxsi post its numbers is getting a little bit of a beating this morning. 5% low on Tata Elxsi. Apart from that, it's Aptus is seeing a correction of 2.5%. PSU banks as a whole pack aren't doing too well in trade this morning. So all in all, there is selling pressure at higher levels. Remember, the GIFT Nifty was indicating to a positive start. Asian markets aren't doing too badly. Wall Street as well ended on a slightly higher note. But despite a whole bunch of positive global cues, nervousness is being felt on our street. So any sort of a minuscule rally as well is being met with heavy selling. And Bank Nifty, I think the consensus out is the big culprit even this morning, guys.
Yeah, all I would add, Samina, is that look at how numbers are getting punished in the markets today. And after results, the impact you're seeing on a Man Industries, a Karnataka Bank, you talked about a Tata Elxsi, a Glenmark, all of these seeing that kind of a push. And you know, if I were to look at a theme, we talked about Puravankara in our stocks to watch, and that one on the back of healthy numbers is up 6%. So this is, in that sense, a time of reckoning as we're seeing Q3 numbers. You've had a fantastic run up all of last quarter in anticipation, and now you are seeing the reality check, so to speak. So numbers that have disappointed definitely getting punished. Quick take from Chandan Taparia and Mayuresh Joshi. Chandan, I'll start with you on you know, where you're seeing the markets going today. A muted kind of a start, not too negative, trying to find its feet, with the Nifty IT showing the most promise.
Yeah. So like 2-3 things we need to notice. First, today India VIX is up by around 5%. So market opened down, recovered, but VIX is at high. So that first thing we need to keep in mind. Because of that, volatile swings cannot be ruled out in the market. For Nifty, now major support will be around 50-day exponential moving average, and that goes near 21,100. So 21,100 we need to look at key support. Upside, 21,400 is the zone. Now if I talk about the Bank Nifty index, we were having key support at 44,444, and exactly it made high near to the same. So that level could act as a key level, and because of that, we may see one bounce towards 45,250. So some sort of bounce could be there in both the indices. However, structure is negative. Bounce could be kept, but those who are looking for early play or some swing, they can play with some bounce. Now, looking at the stock wise, I'll recommend BSOFT as a buy in IT Pack, holding well, lesser risk. So one can go with BSOFT for an upside move towards 830, 840 zone. And apart from that, a selective consumption theme could be in focus. Indian Hotel, after the previous day decline, now taking at key support. So with support of 465, we can see up move towards 485, 488.
Well, you know, Birlasoft has had a really strong move, and no surprise that there is some more upside that is being seen by Chandan Taparia on Birlasoft, so watch out for that one. I want to mark stocks which have come off, and a 1 month chart, for example, of a Praveg, for example, will show you, you know, the importance of paying heed to valuations. Praveg had gone up all the way to 1250 or thereabouts. It's now reeling at 950. Reeling would be a wrong term because it's had a very strong move otherwise. Can we bring the 1 month chart of Praveg? Look at the corrective move that has happened there. Then look at the corrective move that's happened in Angel One. Very strong numbers, but just that the rally was so strong. From 3,800, Angel One is now down to 3,000. Again, a sharp corrective move there. So watch out. I mean, yes, paying top dollar for growth is great, but not at egregious valuations. That's the key point. Now, Mayuresh, come in on Angel One. Now you would be at a liberty to talk about it. So just trying to understand what happens to businesses like these. Very strong growth, but is it priced in? And is that the reason why the stock is now corrected nearly 20-22% from the highs that it made?
Oh, absolutely, Niraj. And again, I think it's an entire proxy to how capital markets will move. And numbers have probably justified the kind of price move that Angel One has delivered over the past few months. But again, I think the price action in the past 3 months itself, the chart that I'm now seeing on the screen, is a little bit too excessive in terms of most expectations being built in. Obviously, the data points that are coming through in terms of a month-on-month, a quarter-on-quarter accretion, the super app that Angel One has created, which means there is a lot of cost optimization that happens behind the dynamics on how numbers will move going forward. But to a certain extent, as you rightly put out, I think there is a certain price that you'll pay for growth in the next 2 years. And if there is an earnings slip for whatever reason in the next few quarters, I think the stock will get punished quite significantly because of excessive valuation. So you have to be very, very careful what you're paying for and what price you're paying for. Anybody holding can ride the momentum. Fresh investors will need to wait for pullbacks.
Then, sorry, you want to?
No, I have you marked Z because
yes, I have.
We have, okay,
5%.
because Z is up 6%.
Yeah. So just a bit of news that has come in on Z. A letter has surfaced, which we also have access to, written by Subhash Chandra to the finance minister, saying that SEBI has not been treating them fairly. And a lot of announcements being made by SEBI will end up scuttling the deal. The timeline of that letter is important. It was written on the 16th of January. Of course, all the events happened post that, and on 22nd, officially that deal was called off by Sony. But Subhash Chandra did write a letter saying that SEBI has scuttled the merger. A lot of news flow around Sony. I mean, that stock fell 32% yesterday. Why at all there is a jump right now is, the key question. And I don't know who would want to speculate on this right now, not with not enough clarity on what's happening next. Mayuresh, is that a stock you're tracking or have any thoughts on?
No, I think Tamanna will wait out for everything that is expected to play out. So just let's wait out for whatever will happen over the next few weeks.
Right, that's Z for us. The stock seeing a pullback after a decline of 30% in trade yesterday. Remember, the price targets were about a 170 odd on the stock, so you may see a little bit of recovery going back to those levels. Chandan, I want to ask you about a shorting opportunity across some of those railway stocks. So Rail Vikas, IRFC, finally after weeks of moving in a one-way direction, let up in trade yesterday. So there was pressure on them. Some selling continues today as well. Would you short any of these rail names? I know budget's around the corner as well, so we'd be a little mindful, but nevertheless, for a quick buck.
No, I don't want to go and short the counter where trend is intact. However, yesterday we have seen good selling pressure, but it doesn't mean the trend has changed. So I'll go with buy on decline stance. You can notice that this stock has really done well, and after small decline, I think that provide the next leg of opportunity. So in fact, I'll go with buy on decline in such kind of name to be with the trend, with the view that first leg of rally could be there as we head towards the budget, and these are one of the strongest sector in the market.
Which ones would you buy at what level is what I'd like to know. Buy on dip, but a price or maybe a level, and what stock would you buy?
Yeah, so looking at the stock wise, I'll go with the IRCTC. There is an FNO as well. As of now, it has major support near 900 to 910. So near 900 to 910, I'll buy with support of 850. I'll look for again 1020 kind of level. If you look at the other stocks in railway, then I can focus on counter like Arvina, Rail Vikas Nigam Limited. Major trend is up. The stock is already up by around 60% in this month. And any decline towards 280, 285, I'll buy for an upside move towards 320, 340 zone.
Okay, watch out for that. Chandan, leave it at that. Thanks so much for taking the time out. Mayuresh, just one quick question. Karnataka Bank numbers, did they seem so bad for the stock to do what it is doing? It is down about 11% now.
I think we'll wait it out for management commentary, Niraj, because there is some clarification that is needed in terms of how the growth dynamics are looking going forward. On the flip side, I think have a look at something like a Karur Base. I think exactly the opposite in terms of both numbers and management commentary.
Okay. Fair point. Wait for the commentary thereof. That's happening in a lot of stocks. People are talking for the commentary for United Spirits as well. Mayuresh, take a moment to thank you for joining in today and giving us your thoughts. Really appreciate your time. Time for a short break on the news that it's a flattish to a marginally lower start. On the other side of the break, a clutch of management conversation. Start off with Granules on their Q3 earnings and then get in L&T Finance Holdings. Stay tuned.